History doesn't repeat itself, but it often rhymes. Millionaires will be made in the next 19 days as the market continues its dramatic reaction to President Trump's Liberation Day tariff announcements. The bigger the market decline, the greater the opportunity, especially if you know exactly which stocks to target during this volatility. The last time Trump unleashed major tariffs in 2018, smart investors who bought strategic companies during the panic were rewarded with incredible gains. This time, the stakes are even higher, with the S&P 500 plunging nearly 18% from its February peak. Understanding this market crash is your key to getting rich without getting lucky. Your time is valuable, so let's get right into it. I'm not here to waste your time, so here's everything I'll cover in this video. How Trump's 2025 tariff announcements triggered the current market crash, the eerie parallels with Trump's 2018 trade war and what happened to stocks afterward. What key economic indicators tell us about recovery potential? Which specific sectors and stocks are positioned to bounce back strongest? And of course, how to position your portfolio to potentially benefit from this volatility. Let's start by examining what's actually happening in the markets right now. On March 21, 2025, President Trump announced April 2nd as Liberation Day, when the U.S. would impose massive tariffs on countries running trade surpluses with America. Markets began sliding immediately on this news, but the real crash came when the details were revealed. On April 2nd, the administration implemented a 10% blanket tariff on all imports, plus targeted higher rates on specific countries: 54% on China, approximately 30% on Mexico and Canada, 20% on the EU, and up to 46% on countries like Vietnam. These are the most severe U.S. trade measures in over a century, raising the effective tariff rate to around 22%, higher than even the infamous Smoot-Hawley tariffs of 1930. The market's reaction was swift and brutal. While stocks held relatively steady on April 2nd itself, they plummeted over the next 2 days as global retaliation became clear. The S&P 500 dropped 10.5% in just 48 hours, from 5,670 to 5,074. The Dow shed nearly 4,000 points in the same period, with back-to-back daily drops exceeding 1,500 points, something we've never seen before. This wasn't just American pain. Global markets also reeled, with Japan's Nikkei plunging 8% on April 4th alone, triggering trading curbs. European indices fell 4 to 6% in sympathy. Market analysis: 2018 versus 2025. Now here's where the comparison with 2018 gets fascinating. During Trump's first term, he implemented what at the time seemed like aggressive tariffs, but they pale in comparison to the 2025 measures. In 2018, he imposed 25% tariffs on steel and 10% on aluminum, followed by targeted duties on approximately $50 billion in Chinese goods. The market reaction in 2018 followed a similar pattern to what we're seeing now, just on a smaller scale. The S&P 500 fell approximately 10% between late January and early February 2018, when the first trade tensions emerged. Then we saw another 7% drop in March as actual tariff details were announced, followed by yet another 20% decline from October through December 2018 as trade negotiations stalled. But here's the critical data point. The market eventually recovered all of those losses and went on to gain significantly once investors realized the economic impact would be less severe than feared. By April 2019, the S&P had recouped its entire 2018 decline and was hitting new all-time highs. The current 2025 situation is following a similar pattern, just with greater magnitude. The S&P has fallen 18% from its February peak of approximately 6,144 to around 5,060 today. The VX Volatility Index, the market's fear gauge, has roughly doubled to over 40, indicating extreme fear. But crucially, this is still far below the 80-plus readings we saw during the 2008 financial crisis. What makes 2025's crash unique is its speed. We've seen a concentration of selling in just a few days rather than the drawn-out declines typical of most bear markets. This rapid decline suggests more of a panic reaction than a fundamental revaluation of the entire economy. So who wins and who loses in this new tariff environment? Let's analyze the competitive landscape across different sectors. First, companies with primarily domestic supply chains stand to benefit most, as they face less direct tariff exposure. Certain industrials, utilities, and some consumer staples fall into this category. Meanwhile, companies heavily dependent on global supply chains are most vulnerable, particularly tech giants with international manufacturing operations. Apple, for instance, produces most of its hardware in China, making it potentially exposed to the 54% tariff on Chinese imports. Similarly, automakers with cross-border supply chains between the US, Mexico, and Canada are confronting potential 30% tariffs on components crossing those borders. However, we need to be strategic here. Many of these companies have already seen their stock prices plummet 20 to 30%, potentially pricing in worst-case scenarios. The market is acting as if these tariffs will be permanent and maximally enforced, but history suggests that's unlikely. During the 2018 trade tensions, companies demonstrated remarkable adaptability. Some shifted production to less affected countries, others absorbed tariff costs through margin compression, and many negotiated exemptions. The largest, most sophisticated corporations ultimately weathered the storm better than expected. For example, in late 2018, Trump and Chinese President Xi Jinping announced a 90-day truce in their trade war during the G20 summit in Argentina. This single announcement sparked a 5% rally in the S&P 500 over the following month. Similarly, in early 2019, positive trade talk headlines contributed to a 13% gain in the first quarter. Heart of the matter. Where are the specific opportunities for investors right now? I see 4 key areas. First, focus on companies with high free cash flows, great balance sheets, and diversified business units across multiple high-growth markets. These are precisely the kinds of companies institutional investors will pile back into when sentiment improves. Historically, high-quality companies experience the sharpest rebounds after policy-driven sell-offs. For example, Microsoft was down approximately 17% during the worst of the 2018 trade tensions, but then rallied nearly 40% in 2019 as those tensions eased. The pattern repeated with tech leaders during other market crises. Those with fortress balance sheets and strong cash flows led the recoveries. Second, look at semiconductors. Companies like Taiwan Semiconductor, TSM, make around 90% of the world's most advanced chips, including those for NVIDIA, Apple, and Tesla. While Trump has threatened tariffs specifically on computer chips from Taiwan that could reach 100%, the market has already punished TSM stock severely. It's down about 20% from its highs. Yet TSM's underlying business remains essential to global technology. Remember that in 2018, 2019, semiconductor stocks were among the hardest hit during trade tensions, but subsequently delivered some of the strongest recoveries once policy stabilized. When macro fears subside, the long-term growth story reasserts itself. Third, e-commerce leaders like Amazon present compelling opportunities. Currently down about 17% since Trump's inauguration, Amazon's diverse business model, spanning online retail, cloud computing, AWS, and a rapidly growing advertising segment, gives it multiple avenues for growth even in a challenging trade environment. Finally, digital advertising platforms like Google and Meta have been hit hard despite having relatively little direct exposure to physical supply chains affected by tariffs. These companies generate massive cash flows and serve as essential conduits for business advertising regardless of where products are manufactured. Of course, we need to acknowledge the risks. Unlike 2018's tariffs, the 2025 measures are significantly more comprehensive and higher in magnitude. Economists warn that such widespread trade barriers could potentially shave several percentage points off global GDP if maintained long-term. The Atlanta Fed's GDP Now model is already projecting negative 2.8% growth for Q1 2025, suggesting the economy could be sliding toward recession. Consumer confidence has fallen to 92.9, a 12-year low, with the expectation sub-index at a weak 65.2, a level that often signals recession on the horizon. However, there are crucial differences from past major crashes. Unlike 2008, banks are well capitalized, there's no housing market collapse, and unemployment remains historically low. These factors provide a foundation of economic stability that wasn't present in previous severe downturns. The biggest risk factor is political uncertainty. Will the administration double down on tariffs or eventually moderate its stance? Historically, when faced with significant market declines and business pressure, policymakers tend to seek compromises. We're already seeing this play out with reports of potential exemptions being discussed and some congressional Republicans proposing legislation to curtail the president's tariff powers. If you found this analysis valuable, consider supporting the channel with a like or subscription. Your engagement helps me bring more in-depth market research your way, especially during these volatile periods when quality information matters most. To summarize what we've covered, the April 2025 market crash, triggered by Trump's comprehensive tariff announcements, shares important parallels with the 2018 trade tensions, but with greater magnitude. Both events caused sharp market declines driven by policy uncertainty rather than fundamental economic weakness. History suggests these policy-driven sell-offs typically represent buying opportunities for high-quality companies once the initial panic subsides. While the current tariffs are more severe than 2018's measures, the market has already discounted significant economic impact. The data indicates companies with strong balance sheets, domestic supply chains, and robust cash flows are best positioned to weather this storm, just as they did in 2018-2019. Political developments in the coming weeks will be crucial, with any signs of tariff moderation likely to trigger substantial relief rallies. As Warren Buffett famously advised, "Be fearful when others are greedy, and greedy when others are fearful." The current environment of extreme fear, as evidenced by the VIX above 40 and the S&P 500's 18% decline, has historically presented opportunities for disciplined investors thinking beyond the immediate headlines. Thanks for watching to the end, even though I gave you everything up front. Until next time, this is Harry reminding you that the best investment you can make is in you.